Welcome out to the Trading Justice Podcast brought to you by Tackle Trading. I'm joined with my brother Matt. This is Mark Justice. Oh my goodness, Matt. There are so many very interesting topics to discuss, and we're going to break
Mhm.
them down one by one this week. But before we get going, brought to you by Tackle Trading. And Tackle Trading is putting on its premier event here in 2 weeks. It is called Master Trader. We talk a lot of technicals. Technicals help us navigate the market, and Master Trader is our flagship technical course for beginners. It is a fantastic event. It has been developed over a decade. I think you got it down. I know you're always tweaking it, Matt,
I am.
but I think you have it down after 10 plus years of
Yeah, I've
teaching
taught
it.
Master Trader a few times in my life. There's no doubt about it. And it truly is one of my favorite things to teach at Tackle Trading. We do it every single month. It's for our pro membership. And the reason we do it every single month and include it in our pro membership and, just kind of laser focus on it is because everybody at Tackle Trading, I want them to have not only a base understanding of technical analysis, but a concrete, amazing understanding of technical analysis so that as we navigate the day in, day out basis with our community, that they have a deep understanding of what we're talking about. They can navigate it through it as well. And if you are looking to, you know, get access to an awesome class that is going to teach you all aspects of candles, patterns, trends, support and resistance, indicators, the SEP method, that's Master Trader. It's the best introductory to intermediate training on technical analysis that you can find. And we include it in our pro membership. So every pro has access to it as every single month. We have people in our community that have attended Master Trader probably 20, 25 times, no doubt, because I do change every single month. We teach basically what the market's doing. So it's a great way to go get some great hot tips out there as well on some pure technical patterns. And so it's on January 26th and 27th. Yours truly is going to be teaching those 2 days. And all you got to do is sign up and be a member of Tackle Trading, meaning you can get a free trial right now, get access to the newsletter, the traders reports, all the different lounges, the coaches shows, the cash flow clubs, the mastermind groups, all those things we do on a week in, week out basis, and test out Master Trader on the 26th and 27th as well. And you get all that for absolutely free. All you got to do, link is in the description below. Just right there says register now. That will have you fill out the form, and on that form, you can get yourself a nice little free trial. And with that said, looking forward to an awesome conversation in the podcast here today as well.
Yeah, let's start. Listen, Jay Powell recorded a video last night, and he wasn't wearing his
Was it a
purple.
hostage video?
It was. In
It kind of
fact,
felt like a hostage video a
it
little
was.
bit.
My
Yeah.
name is Jay Powell, and
I'm
you know,
coming to you from an undisclosed location.
and he wasn't wearing his flavorful purple tie. He was wearing this dark polka dot tie. You knew Powell was being serious and in trouble when he didn't wear his tie of strength. And if you think I'm joking, the man chooses his ties very, very carefully. But Matt, Trump administration hit the Federal Reserve with
Well, you
grand
might as well
jury.
say the Trump administration. It was the Department of Justice. It was the DOJ, but we all know where it
Let's
came.
call it what it is. Come
Yeah,
on,
we all know where
DOJ
it came.
doesn't do
We're
anything.
gonna mince words. We all know
We're
where it
not
came.
going to mince words. Trump hit the Federal Reserve with a bunch of grand jury subpoenas that Powell
Mhm.
says threaten a criminal indictment tied to the whole Washington renovation project. Uh, and, heading into the futures open yesterday and then some overnight caused a little bit of volatility. Markets quickly rebound. We'll talk about the technicals here in a few minutes. But Matt, I wanted to get your take on this. And you and I have not, it's been a busy Monday. We haven't had a chance to talk a lot about this or other
Mhm.
things. But man, does this feel like an unforced error out of the Trump administration?
Uh,
Am I
who
off
was
on my?
asking for criminal proceedings into the central bank from a you lied to us at Congress? Mark, if we did the you lied to us at Congress and we did investigations on it, like we would be investigating for a very long time. And not only that, but Jay Powell, I don't believe Jay Powell lied to Congress in any capacity. You might not like what he has to say,
I
but
don't think Trump believes that Jay
I
Powell
don't believe
lied to
Trump believes
Congress.
that Jay Powell. No, I think Trump is trying to do what Trump does, and he tries to put pressure on to get somebody to move off their position. And Jay Powell certainly has not been cutting the interest rate environment as aggressively as the president would like. But there's a reason that when the central bank was created in 1913 that they wanted to be outside of the political pressure so that we do not, because can we all agree, Mark, that every president, now I disagree with what the president is doing with the central bank here, but can we all agree that every president of the United States wants lowered interest rates?
Yes, that's
Regardless of the environment out there, they want lowered interest rates. And so, obviously, I think that's what this is really about. The president thinks the interest rate environment is about 200 basis points above where it needs to be, meaning the president wants, 1% to a 1.5% interest rate. Jay Powell says we don't have the data for that. Jay Powell says inflation doesn't allow us to do that. Jay Powell says your tariff plan doesn't allow us to do that. Jay Powell says the labor market supports it. Inflation doesn't really support it. And on the backdrop of that, you also have a GDP expectation of 3.8% right now. And so, I,
so you're
and,
saying the
and I,
macro backdrop is pretty decent.
I'm saying the economic macro backdrop does not support 200 basis point in interest rate cuts to spark more inflation. Yes, I think it would be a tremendous mistake for Jay Powell to listen to the political landscape and cut just to save his job. And I also think it's very important that you're right, the market did move on from it, Mark. But I think the market only moved on from it because of Jay Powell's video that he came out last night. And he basically says this is a political situation, has nothing to do with the economy, has nothing to do with what's going on with the interest rates. This is all just a political situation. And because, Mark, we were looking at a scenario last night coming into the market today where you were down 1% coming into the open today. And yeah, the market looked past it, but if the market didn't, this could have got a little bit ugly here and it could have blown up a really, really, really good technical backdrop. And we're going to be talking about earnings here in just a little bit. We can talk about the economic environment. We can talk about the technical environment. We can talk about the earnings environment. But when you look at, say, the technical environment, I do have a point on this, but when you look at the technical environment, would you suggest Bulls control right now, and it's the Bulls pattern and trend to lose here?
Yeah, absolutely.
Okay.
100%.
When you look at the economic environment, would you suggest that we have a pretty decent overall economic environment going into 26?
Yes, I would.
Okay. I'll be the first to admit that there's areas of the economy that are recessionary like. There's people in the economy that are struggling. But we have GDP expansion, profit margin expansion, and we will be going through the fifth, sixth, seventh, and eighth double digit EPS growth this year as well. Which means, would you also agree that the earnings landscape is pretty positive going into this year?
Yes. And we'll talk a
Okay.
lot more about earnings coming
So,
up, but
so
yes.
we have a positive earnings environment. We have a positive economic environment. We have a positive technical environment. And yet the president thinks to start this year, we should have investigations into the central bank. That is an unforced error.
It's
The
an
market,
unforced error.
that's what you were talking about, not putting words in your mouth, but I kind of felt like that's what you were talking
Yeah.
about with the unforced error is the entire environment feels like we're going into 21 and you're expecting a good year this year. You're expecting growth this year. You're expecting expansion this year. And so I just feel like the president is certainly being too heavy-handed on the control mechanisms that he's trying to control through the central bank. And I certainly think he's being a little too heavy-handed on some of what I would describe as far left-wing proposals, such as capping interest rate payments, for
Right.
example.
Yeah, we'll
Like,
get to that here in a second.
yeah, and I don't want to get too in front of it, but my general point is if I could just give a message to the president here is sometimes you just want to take a step back and let things cook. And when you have a positive earnings environment, a positive economic environment, you don't need to be that aggressive here. Allow the United States economy to work. Allow the market to work. Allow the free market to navigate here. And I just feel like we're being a little too heavy-handed on almost everything right now from a political perspective, trying to control price when you should allow price to kind of live and breathe.
Well, Delta Force One wasn't available, so I guess they had to get the Department of Justice to do its work. But Matt, like the unforced error, I think even goes further because, okay, so you want lower interest rates.
Mhm.
This, like just human behavior, what is the Fed more likely to do? Come together in a unified fashion?
Threatening criminal investigations on the central bank is not going to get what you want.
It's
It's
just
just not.
not. It's just dumb.
The
Like,
entire central bank is going to coalesce around one another. They're going to support one another, the same way any organization under criminal indictment would. That's number one, especially when your entire organization thinks this is just political. And then number two, Mark, you had multiple senators, multiple House members in the last 24 hours come out and suggest they will not support any of the president's central bank nominees. You will not get a new nominee this year if you don't
which is
come
important
positive.
because not only do you have Fed Chair Powell's seat up in May, I believe Bostic is retiring at the end of
Mhm.
February. It's either end of February, or early month. So you got seats to fill.
You're
And
going to, I just don't get it. In 4 months from now, you're going to get a new central bank president. Mark, there's only two meetings. Like, there's only two meetings. This doesn't make any sense in any capacity to throw this, this uncertainty in a market backdrop that is pretty positive going into the first of the year.
yeah, I mean, and I believe the market will brush it off like it did today, unless it escalates. But as long as those subpoenas are out there, it throws it, and I believe Lisa Cook's oral arguments in front of the Supreme Court on her case are on the 21st of this
The
month.
Supreme Court's going to rule in Lisa Cook's way on that. It's just, again, I don't understand what the intention here. If the intention is to get lower interest rates, this isn't going to do it, especially when you have all control over nominating the next chair, which is just 4 months away from
Yeah.
now. There's the timing here doesn't make any sense whatsoever. It feels like there's other bad news in the environment from a political perspective that they're trying to wipe away from the headlines. Again, this feels like a Steve Bannon policy, quite frankly, and it's just not good for the market. But I'll tell you, I felt like it was really important for the market to shake that off because when I saw the headline yesterday and I watched Powell's video, and I thought Powell did a good job in his video trying to message to the market.
Especially, I mean, when you have
Mark,
guns
we
in your
could have
head in a
easily been
hostage video.
2% down here. We could have easily been 2% down here. We could have easily broken trend. We could have easily broken pattern. We could have easily faked out that breakout on Friday. It would have thrown a nasty, nasty environment when you have a positive environment going on. I just felt, again, unforced error. That's a proper way to describe it. It just didn't make any sense in any capacity. If you're the president trying to get lower interest rates, you're not going to get that doing it this way.
Yeah, no, absolutely. And let's talk about those credit cards because it feels like Trump is affordability is something that he has started to tweet about,
Mhm.
put on true social messages. It's obvious that someone in his camp has finally gotten through to him because remember, it was just a few weeks ago that Trump was dismissing affordability, saying, "Oh, look at oil, look at this." Somewhere the polling numbers have finally struck with him on the midterms that Americans actually are not exactly believing that previous message.
This is a
And
Bernie Sanders proposal, by the way.
it is a Bernie Sanders proposal that Trump is backing. And he obviously is, midterms already in focus. Listen, American politics, midterms have already started. Campaigning for a policy, all of that. And, a policy that feels like it has very little chance of actually taking hold. What's your take on it?
I think he knows there's no way this is happening.
Do you think it's just a headline grabber?
I don't know because I also saw he put it out on True Social, and then he basically threatened every credit card company with basically treatment of JPAL if they don't abide by it. And it's like this isn't even a law. You posted it on social media. This has to go through Congress. Like it has to go through Congress. And so I don't know if there's going to be any thirst in Congress to pass a 10% cap. And I totally understand what the president's trying to do here. Affordability is a real thing in America right now. 70% of people are struggling paycheck to paycheck, can't put anything away. Inflation, and yeah, the rate of inflation is getting to a controlled level. But that doesn't mean we've seen that those prices that increased a tremendously amount over a relatively short period come down. They haven't. They're still going up. And people's wages haven't caught up to that. And so 70% of America right now is paycheck to paycheck. And affordability is the political term of 2026. It's
Oh,
affordability.
get used to it.
And it's going to happen on the Democrat side. It's going to happen on the Republican side. And so I totally understand what the president is trying to do here to say, okay, we gotta figure out some ways to be a little bit more generous in helping the consumer. Again, capping credit card payments, is that going to get the job done? Is that a policy? So is it understandable that the president is looking for creative methodologies of lowering people's overall costs in America? Absolutely, 100%. I think we should all get creative on that side of the equation. And we shouldn't just shut down ideas just because historically somebody else we didn't like had the idea. We should be open-minded to the affordability situation because Mark, 3 to 5, 7 years from now, all roads lead to UBI. Like every road does lead to some degree of universal basic income, especially as we go deeper and deeper into the robotics and the automation side of the equation. So I don't want to be critical. I don't support a capping of 10% because I think the ultimate outcome of that would actually see less affordability, not more affordability, especially for those end consumers. Because what will happen is if you cap 10% on credit cards, the only thing the banks are going to do is what, Mark?
They're going to lend less.
They're going to cancel your card. They're not going to approve more debt. They're not going to approve more credit card worthiness. They're going to shut it down to you know the people that probably need it the most. And so I actually think the policy, and when Bernie Sanders came out with this policy a few years ago, I had the same opinion on it. And again, I don't want to criticize the policy because I don't think we should criticize ideas that are worthy of discussion and debate that's going to have that would have an impact on alleviating the affordability of a lot of Americans out there right now. They can't get the velocity of money cooking because it all goes to, just life, living expenses. But I do think at the end of the day, this would be a net negative for those same consumers that you're trying to help. In fact, go back to last year, I would much rather have student loans get taken care of than capping credit card interest rate payments, by the way. Um, One you could do without Congress, the other one you can't.
Is Chaos Dawn back?
Chaos Dawn?
Yeah, Chaos Dawn. I
Is,
mean,
is
we've
that new?
seen
Is that a new
that's
nickname?
an that is Chaos Dawn. Like we have seen Trump during certain
Uh,
time periods go
I,
on like
I wait a second. Is he gone back? Did he ever leave? Like, what are we talking about here? Like whether you love the
from a
president, whether you
market
don't,
standpoint, because a
like
lot of the policies,
like
but
he's a
you know,
disruptor. That is
it,
chaos. Like that's what Trump is.
but that disruption has not the market hasn't really felt the wrath of that like it has at different times in his presidency.
Because it has a 13% profit margin on 83% EPS beats with a revenue growth, EPS growth rate of double digit for the sixth consecutive quarter. Like you could be it. the president could have been sleeping last year and we would have went up 20%. It's a good economic backdrop for that. Plus, you have growth narratives, QE, AI trade. So is chaos Don back? I would argue that chaos Don never left. I've never heard that term, by the way. I do generally see the president as a disruptor who tries to get people off their edge to take action. But at the end of the day, yeah, he's a disruptor. Like Steve Bannon is one of his advisors, and Steve Bannon believes that you just put out more headlines and more headlines and more headlines and more headlines. So if you're sick of the headlines,
Oh
they're
no, the headlines are coming, but there have been time periods in 2019, during the spring and summer of 2019, earlier in 2025, obviously with tariffs, and also statements where Trump. I mean, it's easy to forget now. Trump was very hostile to the stock market in February of 2025, very dismissive of it as he had
well,
other
that's because the
things.
stock market was going down.
Uh, you
He's
know,
going to, like,
but
uh, yeah.
is a but do you get my point? That is a Trump that this would be a concern and something to follow. That if these are one-offs, no big deal. If it is a series of additional things,
I fully expect more headlines. I I I disagree with the premise of your statement that is chaos Don back. First of all, I don't think he ever left. Like you look at last year, Mark, we had a tariff rate go effectively up 16% last year over the course of like intraday policy statements that would change throughout a 6 month cycle. So I know that feels like a world ago, but that was only a few months ago. And so, no, I think you can expect a lot of chaos this year. That's why I felt like it was important, and not just from the president. That's not what I'm saying. But again, I do disagree with the premise of the question. I don't think this is something new. I don't think anybody in the world is getting caught up to speed here on the speed of the headlines that come out of the Trump administration. So no, I would disagree with that. I would say yes, you could expect more and more and more and more. Even though I would say to get what he wants, he should do less and less.
those are two on-market friendly headlines. Ask anyone who owns Capital One or American Express
Yeah.
or all those.
Up down, no
Uh,
sell down though.
but Commander in Chief Trump could also be creating some headlines on Iran coming up uh, with market ramification as it deals with oil, with gold, and whenever a geopolitical conflict pops up, that can hit the market itself.
Mhm.
What's the update on Iran that has been escalating in the last few days?
What do you mean?
Like what's going on over there for somebody that might not be informed?
Protest?
And what the result of those protests have resulted in?
We don't know.
But deaths.
Well, if you know, just you give it.
Okay, I will give it
I,
then. I
I don't
was
know. I don't know what you're asking for. We there's protests. The people are stepping up and trying to fight back against the regime. There's hypothetical regime change. I don't know where you want to go with it
Yeah,
though.
exactly there. And there's been hundreds of deaths. And Trump has stated, on his Truth Social account and in to different reporters' questions, that if these protests escalate and they result in harm and death, that the United States will take action. Right
Mhm.
now, what form that action takes form in uh, remains to be seen. Anything you'd like to add to that?
From a market perspective, not really. Increasing geopolitical activity it usually gets a bid on most things, commodities. I would just honestly throw that into the 14th billionth reason why you love gold and silver and more chaos in the geopolitical situation. You typically see those things get a nice little bid. We're seeing that. Um, I do think what's interesting is we're not seeing that same thing play out on crude oil yet. Just kind of hesitating. But no, I don't have a big market take on the Iranian situation, to be perfectly honest.
Well, I got a
It
question for you.
is it is something that I would love to see the Iranian people have more freedom, more freedom to expression, more freedom to navigate. I would love to see, change from a regime perspective in Iran. I know that's not exactly I don't know if that's popular or not. It used to be very popular in the U.S. to support the Peruvian people, but I don't know where the America First or the MAGA movement is on that ultimate question. But I would say from my own perspective, I would love to see, some positive changes coming out of Iran. At one point, people don't remember this, but at one point, Iran was our ally in the 1970s. In fact, we supported Iran during the 8-year war between Iran and Iraq. And so it's fascinating to me, the whole history of that, but I don't really have a market take on it. Like it's just another data point that supports gold, another data point that supports silver. But there's what, 15 data points out there geopolitically that support those areas of the market. But no, I don't have a massive market take. What about you? Like that's
Well,
just me.
my question is, so I do not believe that there would be any boots on the ground. I think that's not even something that will be seriously discussed in any shape or form. But there was something Trump said about we will hit them where it hurts, right? And the
Well, if you want to
only,
hit them where it hurts, let Israel do it.
but it's the oil refineries, it's the oil facilities. Do you think there is any because Trump has
I
been
don't know. Like Trump,
because that would be where it hurts.
is Trump willing to deal with a 20% premium spike on oil,
I
though?
don't believe so.
I don't believe so either. And so I certainly think it makes sense to put that out. But I'm sure they're probably looking at 8 to 10 military options of supporting the Peruvian people. And so
But
I
unless it's oil, there's not
think
a market story here, right?
that's kind of how I see it. I think
Yeah.
it's a human interest story. Like I certainly think that, but I don't think it's a market story unless he does hit oil refineries. But I don't know. I don't know. It does seem like the president does not want to use the U.S. military in a prolonged way. He wants to get in there, take the shots, get out
Well, I
type
mean,
stuff.
no, I think that's exactly right, right? Like Iran with the nuclear facilities, in and out. Venezuela,
Venezuela, in
Maduro,
and out.
in and out,
Yeah.
right? He wants his military action to be fast, decisive, and
Almost like he wants
conclusive.
shock and awe, like without impact,
Which,
without
hey, listen, I think a lot of people would support that, right? As far as versus all
the
other
first Gulf War
alternatives.
was based on shock and awe. Like if you'll remember the Six-Day War in 1991. So like that was a lot of shock and awe. So I understand that, but I just don't think he would hit the refineries because he is so laser focused on cheap oil. He
Yeah.
thinks,
Then
and
there's
I'm
not
not
a market
criticizing
story if
this.
he's
It's
not.
absolutely correct. The epicenter of his economic policy is if we can get cheap oil, everything else gets better. And so, would he take military geopolitical action that harms his number one philosophy that propels the growth story that he has invested in? And I just don't know if he can do that. And I don't even know if it would be the right solution, but I'm just saying from my understanding of the president, I would say he would probably target military personnel even before he would target the oil refineries.
Yeah, that makes sense. All right, let's get to the technicals. You do such a great job on and do a quick technical update, which I know many of our listeners appreciate. You write the newsletter every week. I think you do a fantastic job, and all of those good macro thing, man. It's a pretty good technical backdrop that Trump
Well, that's why I hated seeing the news
trying to
last
blow
night. Like
up.
I was so like I was just like, what are we doing? What are we doing? What are we doing? On a futures open after we just broke 7K? What are we doing? Like I just like, are you trying to stop me out? Like what's going on? But I wrote the newsletter this weekend, and one of the most popular things we do every single week in our community is we write the Tackle Trade newsletter and the Traders Report. Those are the two tackle reports we produce for our community every single week. And in the newsletter, obviously, we do different articles, different videos, same thing in the traders report. But in the newsletter, and I write the technical update in the newsletter each week. And basically, we upgraded the market due to confirmation coming out of the ascending triangle on the S&P 500. You officially closed for the first time ever above 7K on the S&P. And it wasn't just random. It had really good development all week last week. It had really good pivot to start the week, had some consolidation kind of as we broke out on Friday. And so it was a very good backdrop. Pretty clean technical environment across the board. Beautiful trend line, horizontal resistance. That's the ascending triangle pattern. And by the way, if you've ever wondered what's the difference between a cup and a handle and an ascending triangle, one additional increase in support. That's the difference. In a cup and handle, you have your cup and you have your handle, and then you break out. What the ascending triangle does, and I actually like it more than a cup and handle because it tightens everything up on support and resistance, and you can propel a breakout. And so there was a lot of positivity coming into the week this week. Obviously, we also had the kickstart to earnings season, but on the technical side of the equation, it was certainly good enough for us to upgrade to the positive 30 level on the scoreboard at Tackle Trading. And I really talked, basically in the newsletter, because I always try to, teach a little bit as well as, inform, analyze, break down. We want our community to have a full understanding. And so I went through all the different targeting mechanisms of using XYZ targeting methodology, extended trend line, potential average yield, Wyckoff theory, went through all those really popular and really good targeting techniques and talked about kind of where the market could go on this leg. And I should have taken into account that there was going to be a criminal investigation on the central bank that 2 days later. I didn't have the foresight for that one though, Chucky. And so I just felt like that news was just really, really ill-timed. And you talked about how the president last February didn't really care about the market and didn't really care about the timing of headlines, talked down the market multiple times. I just kind of felt like the market was not playing a role in any capacity yesterday on the timing of this announcement because it came out right when the futures opened, like right when the futures opened, and it threw some volatility in the mix. But I thought it was equally important to see the volatility last because we gave up the breakout channel on that volatility yesterday following the Trump PAL announcement. Well, market recovered here going into that breakout. And as long as you stay on top of this trend line, you got to be thinking bullish. As long as you stay on top of that 9 EMA, you got to be thinking bullish. And the market's got a little bit of room to digest before it breaks anything here. You saw that get digested earlier today going into that breakout. So the ES looks to be firing off on most cylinders right now. But where a lot of the momentum is recently is in the Russell 2000, in the Dow Jones. Dow Jones has a wonderful secondary pattern going into the kickstart of earnings. The Russell 2000 slight extension could probably use a little bit of a cool off period, but it has been the cyclical areas of the market that have had really good pricing. And a little bit in discretionary as well, especially on the retail side of the equation. But technically here, like it is a see a trade, take a trade
No,
environment.
it's a good environment.
Yeah, like and that's again one of the reasons I'm a little bit more aggressive with the market did not need that volatility today. It goes against everything the president is trying to achieve. And so I do think I do hope his advisors gives him better counsel on some of
I,
these
I,
things.
and the only thing I'm worried about, and you made
And I'm talking
reference in
about Bassett mostly there, but
is also the timing of the announcement,
it was right
right?
when the futures opened. It didn't make any sense.
That's the kind of stuff I saw back in
You
February.
hide that shit. You hide that stuff on a Friday night.
But back, if you remember back in February when they did not care, you would see market unfriendly headlines pop up 2 hours before
Well,
the market closed on a
but if you'll
Friday.
remember, Mark, he was very aggressive early in the tariff conversation. Besant did talk him down a little bit there. He's being pretty aggressive on some of, and maybe it's not Besant, maybe it's the Republicans in the Senate that talk him down, but Like, and that's what I feel like the market was looking past here today. They were looking past the political nonsense and getting into and focusing on kind of the real conversation. Because sometimes, like, if there's one thing that drives me crazy, it's when we mix politics into the market. I hate it. I hate it. I hate it so much. I wish we wouldn't never do that. Let the free market cook here. We know we got UBI coming down the road. Let the free market cook until then.
Yeah. Let's talk about earnings.
Yeah.
You are my earnings expert. And, but even I, as a non-earnings expert, look at some of the numbers I look at and I'm like, pretty solid, like,
Yeah.
to say the least. And what I'd like to do is I'd like to do a little preview. By the time you watch this podcast, JP Morgan's earnings will have reported. Is JP Morgan now the official kickstart?
They are.
They are.
They
They
are.
are. And so earnings season will have started. And want to go over some of the estimates for the coming year. And, not to steal the conclusion thunder, but it's a pretty rosy backdrop, isn't it?
Uh, this is the best earnings backdrop we've had, and we're not just starting it. The earnings backdrop has been pretty positive for the last 12 months. The last 4 quarters, we've seen double-digit EPS growth. That's really the first time we've seen that double-digit EPS growth since really kind of 21, before the inflationary saga really started taking hold. And so we've had 4 consecutive quarters of double-digit growth, and the EPS expectation for blended growth right now is 8.3%. Average EPS beat is going to be in the 7 to 8% range. That's kind of where it usually is. And so let's say we get a 7% expectation on the EPS beat. You're going to be talking about a 15% EPS growth for the fourth quarter of 2025, and nobody's going to be able to throw, the ultimate R word recessionary analysis on a 15% EPS environment. And so 8.3% going into the quarter is actually a really good number going into the quarter, because these are always low barred expectations that are
And
easily
that's
beat.
year over year growth
Yeah,
from the previous quarter, the
quarter to
previous
quarter.
fourth quarter.
It's quarter to quarter tracking year over year.
Yeah, okay.
Yeah.
And so 8.3%.
Mhm.
And what have the last few quarters been?
Well, when you look at the actual last few quarters, 12, 13, 14, we started at 6, 7, and 8. All of them got it around that 7 to 8% EPS beat rate. All of them were in the double-digit growth. And that's also expected for this year, for the entire year this year, Mark, is expectation of double-digit growth going into this year. And so the expectation of the fourth quarter is 8.7%. But when you look at, say, as we start cooking into the first quarter of 26, the second quarter of 26, the third quarter, the fourth quarter of 26, you start to see some really positive EPS numbers, quite frankly, for those timeframes. There was a graph in the FactSec document, and I'm just trying to find it here, kind of looking at it from a quarter to quarter to quarter perspective. But right now, I can't find that graph necessarily. There's a lot of graphs in FactSet. There are. It's my go-to every single Friday. Like during earnings season, I do a general earnings update. I couldn't do it without FactSet. FactSet is awesome. I love FactSet. But put it like this: from the first quarter to the fourth quarter of 26, we're expecting an average of about 13, 14% EPS growth next year. For the fourth quarter last year, we're expecting 8.7, which will be in the 13 to 14% range based on the average EPS beat and the veracity of that beat. That's not a bad environment. That's not even a lukewarm environment. That is a very positive earnings environment that we currently have. And that's why I say it, when you have positive earnings environments, positive economic environment, you have growth narratives and themes in the market right now that the bulls can connect with. How about you don't throw political grenades into this market right now?
It's a really good
I
backdrop.
don't think that's a tall ask to just keep the politics out of the financial world. It's you will like it more if you don't get involved. Now I'm speaking to the president on that one. Even yeah, I won't continue on that, but I just think it's a pretty decent environment that doesn't need additional uncertainties in there. We have enough geopolitical uncertainties. We don't need political uncertainties in this market as well. But yes, it's a very good EPS backdrop. Revenue looks really good going into the fourth quarter reporting season as well. And you also got obviously the banks report this week. You got Taiwan Semiconductor that reports this week. Start picking up some of the growth narratives next week. But in general, Mark, the first two and a half, think about it like this. Until we're into the first week of February, like 18% of the EPS reports in January, 82% of the EPS reports in February.
Okay, so that's obviously the company, and I'll get to those big Mac 7 companies here in a second. But Matt, you know, oftentimes one of the great Wall Street tricks is low bars set for earnings season, then we surpass them, and then voila, you get a string of dozens, if not hundreds, of headlines of companies beating. But it's the game Wall Street plays.
And they're very
Would you
good at it.
would you say with 8.3% that there are low bar expectations, or are those expectations a little elevated?
I think there's low bar expectations for the general market, but technology is a little bit different because it's not, you are right that the market and specifically the stocks in the market and the analyst and the earnings game, they lower that EPS bar, right? And from 2022 all the way to the third quarter of 25, you had a very low bar in earnings. Now, oftentimes this was because earnings was not great, but you had not only a low bar, but you had a negative impact going into earnings season. So, for example, in 23, 24, and 25, the month before earnings kicks off, you see these revisions. And in the third quarter, the second quarter of last year, those revisions were negative 4.2%. The first quarter of last year was negative 4.2%. 4.2%. Last quarter earnings season was the first positive expectation that we've seen since 21, since the fourth quarter of 21, where you had a slight bump up in EPS expectation going into last quarter. This quarter does that again. You have an additional bump up in EPS expectations coming into this quarter, which means is the bar still low going into the quarter, even if revisions went up?
Mhm.
That's the ultimate question,
Yeah,
right?
that's what I was curious about your take on.
The answer is yes, it is. And the reason being is for twofold. I don't just take into account the earnings game on EPS revisions in terms of the low bar. I also look at that through a technical lens as well. And we have not had an official leg up in the market since before last earnings season. We've been going through general
We
consolidation,
basically took
ascending
3 months off.
triangle. From an overall perspective, that is accurate. And so it's not like you've been pumping going into this earnings season. It's not like the market's been screaming up for 3 months and you're very elevated. You're not elevated from a technical perspective. So I'd say a little bit of lower bar from a technical perspective. From the overall bottom up EPS, which we've seen a zero point 0.5 increase in EPS expectations in the last month coming into this earnings season, that is because we've had over 6% increase in technology itself, Mark. And so when you're thinking about where that 0.5% is coming from, is it coming from utilities? No, they've had a downward drift of 6.2%. Healthcare, downward drift of 4%. Staples. So four sectors have had a positive, three sectors have had a positive. You've had tech at 6.1%. You've had finance at 1.2%. And you had energy at 0.3%. Everything else is to the negative. And so tech and finance are the two areas that have really led to the EPS being increased in expectation. And a lot of that increase in expectation is based on NVIDIA and the semiconductors and the AI trade. And their expectations are fairly elevated right now. So, but I don't think I'm breaking news by saying the AI trade, everything's a little bit elevated right now. And so I would say in the general market, if we were talking about RSP, for example, I'd say no, we have a similar scenario, low bar expectations, just need to overcome that and need to overcome that based on higher than the average beat. You do have some high bar expectations going into technology itself. And it's not just the EPS story here, which is a really positive story. Mark, you had 32 companies for the fourth quarter increase guidance in technology. Did you know the record is 36
I
companies?
did not.
36, and we're coming in at 32 right now. And when you think about guidance in general, usually about 40% of companies are increasing guidance and about 60% of companies are decreasing guidance. Right now, you have over 50% of that guidance being on the positive side.
All right. So putting this together, and once again, I am not the expert you are. When I look at this and I look, when I look at the previous graphs, what I see is most companies trying to do the old trick of lowering expectations, but technology not. And that is resulting in that 8.3%.
Well, so
Like,
it's resulting in the 8.3 total, right, on expectation.
and the fact that revisions, the,
But it would have been 7.8.
okay.
Okay. So I track this throughout the entire earnings season, right? In EPS blended growth. So we're going to start earnings season at 8.3%, right? That's the starting point on EPS growth. And if that number does not achieve 14%, we're having let's say it ends 12 to 13% mark. We're having an average earnings season at 12 to 13%. And I know that might seem crazy to people. Like, what do you mean 12 to 13% growth and that's only average? When the expectation is 8.3, well, it's not just me that knows the earnings game. Wall Street plays this as well. And so if we don't get into 14%, because the average beat on EPS is between like 6 and 8% in the last 10 years. So let's just say 7%. So if we're not at 14, 15%, we're under we're underperforming the average blended growth increase throughout earnings season. Last earnings season, we went up 6, 7%. The time before that, we went up 5, 6%. And so you can't come in at 8.3 when that's the expectation and say, oh, we did our job. No, market's always pricing for the future. You come in at 8.3, you celebrate the past, and the future sucks. You got to come in at 8.3% plus average expectation on beat. And so you got to come in around 14, 15% on the EPS growth rate to really kind of kickstart it. So basically, what happens here on high bar, low bar mark is if you look at the 8.3% right now, which is the average EPS, the S&P 500 EPS beat rate is 8.3%, or blended growth is 8.3. If it wasn't for technology on the increases of expectation, we would have started earnings season, say, at 7.8%, and we would have needed only to get to 13, 14% to have it successful. With that elevated increase, you now have to achieve a little bit more. And so it's the same process. It's the same. You need to go up by 7%. It's the same thing. It's just where do you start that conversation? And so we're going to start that conversation at 8.3%. That's where the blended EPS growth is right now. And in the first couple weeks, you want to see that hover 8.3, 8.5, 8.7. You want to see that slow build up. And then when Max 7 and Technology Week starts happening, you want to see that jump to 12, 13, 14%. And so it's a fascinating earnings story that gets told over earnings season, but I would say slight elevated bar because of specifically technology.
Would you be shocked if we don't have a solid earnings season?
Yes,
Yeah, I would too.
I would be
Like,
absolutely blown out of my mind shocked.
yeah, I mean, this should be a win for
This
that.
is a this is a softball play. This is
Yeah.
Randy Johnson ain't throwing that 100 heater right now, Mark. This is old Grandpa Mark tossing a softball to his grandkid.
Yeah, no. Yeah. Any last thoughts before we get to the game of the week?
I love earnings season. I truly do. I think it's so important to understand how earnings works, not just from a macro thematic perspective, as we're talking about in the pod, but earning strategies, techniques, how to navigate it as a trader, as an investor. It's something that goes on four quarters a year. You got to learn how to navigate it. And this is a great time to come to Tackle Trading, sign up for a free trial, and come hang out and navigate this earnings season with us, because I promise you, and Mark, you'll probably attest to this, you will learn more about earnings season, fundamental analysis, just by listening to our Traders Lounge conversations on earnings days than you will on any video archive out there. Would you agree with that?
Absolutely,
That is a
100%.
fly on the wall, and listen to us break down earnings report after earnings report after earnings report. You'll learn how to navigate that conversation as well. And we do it every day. We cover all those earnings reports every single day in the Traders Lounge. So definitely come check us out. Obviously, pro members have access to the Traders Lounge, and we cover these conversations every single day in the lounge.
All right. Game of the week is called the Ministry of Markets. Are you ready to play the Ministry of Markets? Because it is the year
Um,
2026.
I kind of feel like the Ministry of Markets here, huh?
Ministry of Markets, the total financial surveillance state.
Um, let's do it. Yeah, yeah,
All
I'm
right.
down.
So it's the
I'm
year,
down.
the year is 2026 in the not so distant future, and markets are no longer free. Every citizen is assigned a capital function and a trading ration. You are given three areas, and you must go long one through December 31st, 2026. You
So
must
I got to hold
short,
on here.
you got to hold all year.
Okay.
You must short one through
So
December
so
31st.
we're playing the Mary Kill game.
Yep, essentially, but we're doing
So
it in a
okay,
much
so
more
I
clever
got
way.
I got I got to marry one for a year.
Uh-huh.
I got to kill one.
And
And
you're
what?
allowed to trade one for a year. So you can go in and out however you
Okay,
want.
so I have to pick. I have all three. I gotta assign a category to each three.
Yes, you do.
Okay, I understand your game.
Yes, it's called the Ministry of Markets.
The Ministry of Markets, or we should just call it the Ministry of Mark.
All right, first one, we're going to do a Mag 7. Apple, Tesla, Google.
Apple, Tesla, Google. That's your question.
Yep. You got to
Um,
go long one, short one, and you're allowed to trade one however you want, as the Ministry of Markets has
uh,
rationed out
it's
your
not
trading
even
capability.
competition. If you're holding periods a year, it's Google. Google has a fantastic environment coming into 26. This is probably the most popular Mag 7 company held by Wall Street as of right now. And so I would absolutely have to suggest Google on the hold. And then when you're looking at, the shorts, like Apple cannot catch a bid here. Like we're talking multiple time frame breakouts. Apple can't catch a bid. Got a little bit of a reversal playing out here. A little bit of a deeper pullback. You're gonna have to fight a lot getting back up. And I just don't love Apple going into, like, they had a really good trend in the fourth quarter last year. iPhone sales were pretty decent against expectation. I would certainly say tradable. I wouldn't short Apple for a year, but if I had to pick, I'd say Apple against those three. And then on the tradable side of the equation, there's just not like Tesla's one. You can do whatever system you want on Tesla. You can trade boomerangs on TSLL. You can do covered calls and boomerangs on TSLL. You can do credit spreads on TSLA. I think TS and plus, let's face it, you don't get you you're not gonna stay bored in Tesla. So I'll say the tradable asset would be Tesla. So long go marry Google, kill Apple, trade Tesla.
Ministry of Markets accepts your ration. Going to give you another fairly easy one, but with a degree of difficulty. Gold, silver, copper.
Gold, silver, copper. Marry gold, trade silver, and kill copper.
There you go. Now the Ministry of Markets was very benevolent on you. He's going to increase the difficulty of the next one. Semiconductors. Micron, Nvidia, and
Oh,
Taiwan Semiconductor.
that ain't easy. That ain't fair. That ain't
Listen,
that ain't fair.
we must ration the trading out there.
Um, I'm marrying Nvidia.
Ooh,
Without Nvidia's, people are so spoiled with Nvidia. Like it's absolutely ridiculous how spoiled people are with Nvidia. Without Nvidia, that same earnings conversation is a vastly different conversation. We're talking about, you want to talk about why blended growth at 8.3%? You want to talk about why we're seeing a 6.1% increase in EPS expectations in tech? It's because technology has a 25% EPS blended growth expectation mark. Now, without NVIDIA, that number goes down to 18%. Not without Apple, not without any of those other ones, without NVIDIA. In fact, NVIDIA is the number one company in the entire S&P 500 producing blended growth right now. So, marry NVIDIA, discount the neutrality right now. The year's a long year. Marry Nvidia, trade Micron, kill Taiwan, and that saddens me because I love Taiwan, but they're the ones with the biggest geopolitical risk, and I say that even knowing Nvidia and their ties to China, but that I have concerns with the, and I don't want to get in it too much here, but I do have concerns with the message that what we did in Venezuela sends to China and Taiwan.
there you go. See, this is why the games are so fun. That are great analysis. Great analysis. Ministry of Markets feels
I've never
very.
seen a demand equation like we have on Micron right now. Like,
Now, now we're going to go energy, uranium, oil, or energy stocks as a whole, as judged by
say again,
XLE. Uranium,
URA,
oil,
okay, USO.
and then energy stocks as measured by XLE.
Um, the marrying uranium, I don't think it's a tough call. Um, I'm trading crude oil and I'm shorting energy.
Ooh. All right. Final one. The Ministry of Markets is very satisfied. We didn't like some of the answers of previous traders that came to us, and we had to subpoena them. And so they will have to record their own hostage videos to get out of their trading prison. Final one.
I didn't have it on my list that the central bank president would be recording a hostage video this year. Like I did not have that on my list. Like,
Uh, Final one. Cyclical and defensive heavyweights. JP Morgan, Home Depot, and Walmart.
all right, JP Morgan, Home Depot, and Wally World, correct?
Yep.
I'm marrying Walmart. Affordability crisis supports Walmart because you're not getting a cheaper price out of the consumer than Walmart. Um, so yeah, I'm marrying Walmart. I'm going to trade Home Depot. I like the reversal playing out. And I'm going to kick JP Morgan and Jamie Dimon to the curb because I know they're not supporting of gold.
They're supporting. They're just supporting of short.
Keep shorting it, you'll keep getting busted. Actually, JP Morgan actually owns, like, they're the number one institution that owns gold and silver. So I kind of joke on that a little bit, but yeah, I'm gonna marry. Yeah, those are my answers.
All right.
Marry
Let's get,
Walmart, trade Home Depot, short or kill the other one,
all
JP.
right. Got Coach's Corner, two for you, one for me.
Yeah,
To finish up the podcast. One, this one's for you. Do you have a favorite earning strategy? What are your typical expectations for it? These are all from listeners.
I'm a sucker for a volatility build strangle. I do like them, and I also like Coach Gino's debit condors on earnings plays. They used to do it through inverted butterflies, trade the volatility cycle. But I widely prefer the Devicon that Gino basically dominates. So I would say for volatility build 4 to 5 weeks out, straddles and strangles. I prefer the strangle, a little bit more cost effective, more efficient in my opinion. But people swear by the straddle as well. For volatility crush, I would say the Devicon.
Next one I'll take. Do you have any kill indicators or situations that you do not place a trade on a stock that other traders might not have? And this is
What do you
this
mean?
is so basically they're saying, are there things and indicators or situations where you won't place a trade where other traders might not veto that trade or kill the trade based on that indicator? And let me give you an example of what they're referring to. Well, I don't know if they're referring to this, but falling moving averages on monthly and weekly timeframes are a perfect example of,
Oh, the weekly 9 EMA is a killer for me. The monthly 9 is not.
you know,
So yeah, I do think it over time, like as you start to kind of customize the things you love, right? How you navigate, how you parse information. Like Coach Frank and I are two Borg-minded traders. We've been connected at birth. Um, but yet we have some differences. And one of those differences is on the indicator side of the equation. Um, I don't put into the same degree of emphasis on swing trades on monthly moving averages that Coach Frank does. And I was actually talking about this in the Traders Lounge the other day. Some question got asked, and I said, at some point, you got to learn how to discount certain forms of analysis because if you don't, you're never going to trade. Like, if you have to have the heavens and the earths align for you to make a trade, you're not a trader. You should more likely be a position or an investor because you're never going to get the heavens and the earths to align. Not every indicator is going to support what you're doing. When I was a young trader, I used to know these people that would be like, all right, you need the moving averages doing this, and MACD stochastics and RSI all doing this, and you need your, like, I'm like, really? I need all of that? Like, don't they all take their cues from price? So for me, I need price to confirm. That's really it. And then I look for reasons that could stop price from going to where I expect it to go. And that's when you get into the weekly versus monthly pivots and moving averages because you're going to want to cross check different time frames. I have rules on weekly moving averages. I do not have rules on monthly.
final question. What are the most common mistakes made in earnings season?
Holding call options through earnings, thinking you're going to get rich quick when you don't understand every aspect of that was already priced into the earnings, into the call premium when you bought it.
And we just expand on that in a second because I love that answer so much.
Degenerates think they could just go out to the market and buy a call option or a put option in front of earnings, and they feel like it's a cheat code out there. It's not. Believe me, it's not. Mark, is is there certain expectations that we know are going to play out in earnings? Like,
Yes.
for example, we're starting at 8.3, but it's going to go to 13 to 14. Like, I
Yes.
know certain things. So does the market. The market is very smart. The market is very efficient. And I promise you, you don't know more than the market knows. The market knows the average beat. The market knows the average expectation. The market knows, in fact, the market will price in basically the average gap range of the last four earnings, and they'll just call it the quote unquote market maker move. But they understand the volatility cycle. The market understands how many times a company like Taiwan Semiconductor, for example, gaps and runs on our earnings. The market knows Taiwan Semiconductor moved only down 2% last quarter. The market knows the quarter before that the market gapped up right around 3% last quarter. And so if you go back to say the entire year this year, and you go look at every one of these earnings gaps, for example, you see right around and I'm looking at Taiwan Semiconductor, right around a 9 point gap on the first one. Then you had right around a 4 point gap, and then you had about a 7 point gap, and then you had a 2 point gap. So the most you've gapped is right around, 8 points. The least you've gapped is right around 2 points, which means you're not going to get a big, you know, efficient call option going into that. The market's going to price that in. And so when you look at the market here, Mark, Taiwan Semiconductor expires in 4 days from now. 4 days from now. But if you were going to have to buy an at the money straddle on Taiwan Semiconductor, so we're just going to buy the at the money straddle, it's actually going to cost you 17. 17. Because 14 of that is embedded in the price. So we have an average expectation of about 7 points on Taiwan Semiconductor. Seven up, seven down, 14 is built into the price. You're paying for that expectation. And so if you think you can just go to the market and say, ooh, we know Taiwan Semiconductor is going to gap up 14 points. We don't know if it's going to be on the call side or the put side, but we know it's going to gap 14. So I can just go out there and buy a call option today. No, 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 no. That 14 points is already in the options market. And so it's I do think it's the number one mistake. And I think it's a rookie mistake. I think it's a go to the moon type philosophy. And you don't understand that you're going to get absolutely destroyed on that same, like, even if it moves up 14 points, Mark, you're going to lose money. Even if it moves what you expect it to move, you're going to lose money. Why? Well, the reason you're going to lose money is implied volatility is going to go down. And so volatility is going to go down on the release of the earnings report. That pricing power now comes out. You lose money. It's degenerate gambling at its best to just buy a call option or to just buy a put option in front of an earnings and expect to see greatness here. That is already priced into the market. You need to see the market move 1.5 times expectation for you to get outside this volatility cycle. Don't like your odds. It does happen, but I don't like your odds.
Well, that is fantastic. Fun podcast, bro.
Yeah,
Send us out.
I enjoyed the podcast as well. If you love the podcast, you love listening to the podcast, give us a nice little like and share on whatever platform you are watching, typically on YouTube. And just from us to you, just want to say just thank you so much for being the best part of Trading Justice, the best part of Tackle Trading. Obviously, this podcast is brought to you by Tackle Trading. But it is you, the listener. So just wanted to say thank you so much for being the best part of it. If you love the pod, give us a nice little like and share. And hit that link in the description and register for this month's Master Trader class because we're going to have a tremendous amount of fun. And with that said, I hope everybody truly has a wonderful week and enjoy the kickstart to earnings season.
Have a great week, everyone.